Good evening. Tonight we are going to be discussing Chapter 4 in Financial Accounting. Chapter 4 covers internal controls and cash. Lots of times the cash chapter becomes, seems much easier than some of the chapters that you've worked on up to this because everybody knows how to handle cash. The first item that we want to talk about and the reasons that we need to have internal controls is fraud. So we would want to describe fraud and what its impact is on a business. First of all, fraud is not a mistake. Fraud is an intentional misrepresentation of facts. It causes injury or damage to another party. It increases with expansion of e-commerce via the internet. More and more people get their account numbers stolen. I mean, we see it in the news all the time. So some common types are insurance fraud, check forgery, Medicare fraud, credit card fraud, or identity theft. As we start working into third world countries more and developing countries, that's where we see a lot of fraud originating from. If you get an odd-looking charge on your credit card now, the credit card company is going to call you and ask you if you actually made that charge because it looks like suspicious activity to them, so they try to protect their cardholders. There's two common types of fraud that impact financial statements. We have misappropriation of assets or fraudulent financial reporting. Misappropriation of assets could be the theft of money or inventory. Maybe you work in a retail store and you are a closer, and at the end of the day you carry out inventory with you without paying for it. We may have bribery or kickbacks. If you buy goods from a certain supplier, they may pay you cash to buy from them. And you could overstate an expense reimbursement. So maybe you have a business trip and you turn in your travel to get that reimbursed, and you turn in things that are not really legitimate business expenses for that trip. You can have reporting errors or fraudulent, they're not errors, not if it's done on purpose, committed by managers, and they make false or misleading entries into the books. Sometimes you'll have folks write checks to fictitious vendors, and that vendor is themselves. And this deceives your investors and your creditors. We always would know that we have a chance for fraud, and there is a chance for fraud. The ultimate unethical act in business. You have to have three things in place, and we often think of that as the fraud triangle. You must have motive, a reason to do that. We need to have an opportunity, right, to commit the fraud, and we have to have rationalization. So sometimes, you may have a critical need or greed. Lots of times you will, if you catch someone stealing from a cash register small amounts of cash, they might tell you that they needed to buy baby formula or Tylenol for a sick child. And it just seems like such a critical need to them, and it's a medical emergency, and they feel like it's the only way that they can solve the problem. And often people who commit this type of fraud or theft really do plan to put the money back, but putting the money back then creates just another chance for getting cut or caught, because having too much money in a register is a mistake too, or a problem too. It causes people to look into it to see why there's too much money. So to explain the objectives and components of internal controls, why we have internal controls in place, we want to try to make sure that we can prevent, detect, or correct fraud. You want to catch these items, or first you want to prevent it. Hopefully you've got a secure enough system in place that you can prevent fraud. But if you can't prevent it, hopefully you've got systems in place that will make the oddities pop so that you can go back in and investigate the items that look like they may be illegal happening. And then the lastly, we want to be able to correct those items and And our policies are going to guide us toward that at all points in time to make sure that we can correct our fraud or errors. Management and board of directors must implement a plan of organization. They must have a system of procedures in place to follow. So some of the objectives of internal control are we must safeguard our assets. If you go into any of the classrooms at Ivy Tech buildings, you see that the computer labs have keypads or locks on them. That's safeguarding the computers in the classroom so that they can't grow legs and walk away. We also have security cameras, so if you do by chance get your hands on something you're not supposed to have and walk out the door with it, we have you on film to be able to track you. That's an Ivy Tech safeguard. Many businesses use the same thing. We encourage employees to follow policies. Policies should be updated on a regular basis if we find a hole in the policy or a loophole that someone is able to slip through the cracks with something because policy doesn't support it the way we think it should, then we need to update that policy. We want to promote operational efficiency. We want to make sure that we have the proper guidelines in place to do our paperwork and track our financial statements the best we can with no errors. We want to ensure those accurate, reliable records. Again, if we have operational efficiency, we are headed toward those accurate, reliable records. And we also want to always make sure we are complying with any legal requirements that are put in place. For example, we have to have a internal control policy in place, and we have to sign off on that with our independent auditors that we have that policy in place and that we follow that policy. The Sarbanes-Oxley Act, or SOX, made it so that companies must have a system of internal control. They have to issue that internal control report. Again, the auditors, this is what I was just saying, the auditors must evaluate and report on those internal controls. We have to create public company accounting oversight board. Someone in this public company accounting oversight board makes the rules for what our internal controls should look like. We limit non-audit services of auditing firms. What that means is I shouldn't be calling up the CPA firm that's going to do my audit and asking them for advice on how I might depreciate a piece of equipment or how should I record a purchase of a building, because in effect that auditing firm or CPA firm would then be auditing their own work, and they should be more separate than that. So that's why you should have a non-audit services not performed by your auditing firm. And there are penalties for violators put in place now. People can do jail time and be fined for not following the rules of SOX. So we want to have some protection against our company assets, so think of your internal controls as your shield that keeps you from having fraud, waste, or inefficiency happening in your business, helps you to make more money. I like this little risk assessment house here because as we look at this, we see that the roof is our control environment. The risk assessment is what's the danger up here in the sky. Monitoring, we're looking out the window to watch and see what's happening out here outside of our little controlled environment, and we can see inside that we've got control procedures in place, our locks on our doors, and we have our information system, which is our computerized system that we hopefully have a secure system that can track and catch errors. So again, we have the control environment, risk assessment, information system in place, control procedures, and the monitoring of those controls. The tone at the top makes a big, big difference in how the employees act within a business. You need to set that tone at the level you want your workers to perform. You should have a code of ethics in every business saying what is considered ethical and what is not considered ethical behavior for that company. We want to identify our business risk and establish procedures to deal with those risks. For example, if I am a cash basis company where people come in and pay for most of their purchases in cash, I want to make sure that I have a receipt system in place so that my employees can't just put the money in their pocket and not give the customer a receipt. We want to be able to track any cash that might not be recorded. And again, our information system should capture, process, and report those transactions so that we can track them. We want to have a built-in control environment. So for cash registers, for instance, something as basic as that, we would want to make sure that only one person had access to the drawer at any given time. We want to make sure that there's always a tape in it tracking the sales. And we want to make sure that the person who is running and keeping track of the money in the drawer has an opportunity to count that drawer back and not rely on someone else to count the drawer. In today's society, that's happening less and less. You hand off your drawer to someone else and they count it and then they say, oh, you're sure. That's a little scary to me, and I would think it should be a little scary to you. Now, if they're counting it in front of you, that's different, but and if it can be verified by you, that's different as well. And then we have the monitoring of those controls. These controls are programmed into the company's information technology, and then we have the internal and external auditors monitoring those controls to see if they are working well. If not, we make adjustments and move forward. So internal control procedures, we want to make smart hiring practices. We don't want to hire someone who was just fired from the last job for stealing. So we can do background checks. We want to do some good training and supervision. We want to pay people a competitive salary. It's really hard if people aren't making a living wage. We want to have clear employee responsibilities, which leads us to the next item of separation of duties. We need 3 key duties separate at least: the asset handling, the record keeping, and the transaction approval. I should not be able to say, oh, I need to buy me a new computer for my office. And so then I just say, okay, I want to just go buy the school's money and buy a new computer for my office. And then maybe I have the ability to write the check right out of the school's checkbook, which I don't, of course. But to purchase that asset, that would not be separation of duties. It should be, oh, I need a new computer for my office. I am going to request that new computer from my department head, and then my department head can actually approve or disapprove that. It goes on to the business office, and the purchase order would be processed, my computer gets ordered, and then the business office pays for it once it is delivered. I should have an operating budget and a cash budget, and I should compare those two. I should do what is called exception reportings. We should do this with many areas of our life. Anything that seems out of place or abnormal, an exception to the general rule, we should look at it to see if there's something wrong. It doesn't mean that there's something wrong, but if it looks funny, we want to investigate further. And we should always do audits. They're required, if I'm a public company, they're required quarterly to make sure that my numbers are in compliance with GAAP. I want to make sure that adequate records are kept to have details of business transactions. Are all of my debits and credits equal? I want hard copies or electronic copies of all documents. More and more companies are going paperless, so their documents are filed electronically, scanned in. If you're using an electronic system, totally paperless, you want to make sure that your filing system on your computer is adequate, that you can find the items as you need them. And it's important to use pre-numbered documents. That often means check stock. You don't want to buy checks without a number on it and let the computer just print the number, the printer print the number as you're printing the check out, because realistically, people could write checks and then just reuse the number, and that would be hard to find and hard to track. You should have limited access. That means physical access to assets. That's what our keypads do on the doors at Ivy Tech. If I'm in an office building, I may keep my door just locked. I may have card access to where I have to access. More and more places are going to the fingerprint, where you just have to put your hand up to get in. You should have a lockbox system, meaning that when payments come in, it goes into a locked box, and it's not ever opened when just one person is there. That box always has at least 2 personnel when it's opened. If you do a night deposit box at a bank, one person doesn't just open those deposits. Typically, you've got 2 people there when every deposit is open and looked at. We want to make sure we keep, again, locks and keys on our computers. We keep everything password, and we use encryption, so that encrypted files, so that when we are sending documents electronically, they can't be easily accessed if they get in the wrong hands. We want to make sure we have special approval or approval system in place. Again, I might say I want a computer, so I complete a requisition. If that requisition gets approved by all the approving bodies, then a purchase order can be written at that time and the computer ordered. We should have a credit department who is overseeing the people we support credit to or supply credit to, and the purchasing department should make sure that the people that they are buying from and sending money are legit companies. And of course, the human resource department would want to make sure that all of the employees they hire are who they say they are, that they have the training and the credentials that they say they do. Accounting systems are important technology in today's world. We have less manual procedures, and then we have more information available, or IT. It's computerized systems doesn't mean you won't make mistakes, and it doesn't mean that mistakes are easier to find. A computerized accounting system is just as good as it's set up. So if it's not set up correctly, you're never going to have correct financials in the end. And if you have someone who doesn't understand that a cash payment reduces cash instead of increases cash, meaning, which they don't know which side to debit or credit on, then you're going to have mistakes and your books aren't going to be correct regardless of how they're entered in the system. And then we may have things like electronic sensors or barcoding to help pull the prices off of items in the stores. And anytime that we're doing something without people input, it should improve the accuracy of your numbers, and it's faster. So ways to have safeguard controls in place is to require job rotation, have fidelity bonds. That doesn't keep things from getting sold, but if you have your key people bonded, then if they do steal from you, then insurance has to pay it back. That's what a fidelity bond is. Have alarms in place. You have loss prevention specialists, in the stores to try to watch for shoplifting and that type of item. You require vacations. Often if you have, especially in the financial world, if you have someone who refuses to take a vacation, they just are never taking their vacation, or they might only be gone at 1 or 2 days, so they never miss a payroll or something like that. I mean, they could be trying to hide something. So it's lots of times, especially banks are notorious for making people take their mandatory vacations all at once so that there's a gap. And anytime someone else has to come in and work on the job, they might see something that looks out of line and catch something that's going on. We should have fireproof vaults to protect our backup files. We should probably always keep, we should always keep a backup file off-site, have our computer backup somewhere off-site. It's easier and easier today with items such as the cloud and Dropbox. You can pay to keep your files electronically backed up offline and not taking up all the space on your computers. And of course the security cameras in the middle. We all like to be caught on cameras. We make jokes around the office sometimes. We'll we'll be somewhere and we'll do something really silly that you wouldn't want anybody to see, you know, outside of the person you're talking to, and they'll say, yeah, there's a security camera right above your head, you know. And so we kind of, you know, we kind of make fun, and then every now and then we'll make faces at the security camera just to try to lighten up the mood. We figure if someone's watching, then if we make them laugh, that's a good thing. But they do catch so many suspicious things happening that, you know, if you have to go back and look at it, you can find things. So if we have e-commerce or we're buying things on the computer, we hear all the time, as I said earlier, about stolen credit card numbers. You can pick up computer viruses and Trojan horses, and there's things such as phishing expeditions where you'll get thrown to a website if just by typing in one keyword wrong, or maybe you get something in on your email and you click on it, and the whole point is to get information from you. Security measures include encryption and firewalls. These help to protect you from the loss of your information that you need to protect your secure information. There's always limits to anything that you do in business, and it's called the cost and benefits measure. You should only put something in place if the benefit outweighs the cost. There's not a lot of value in putting in some type of fancy security system that keeps you from losing $100 if that system costs you $100,000. However, if you could put something in place for, you know, $20,000, it saves you $100,000, and it's very much should be put in place. There's other things that you have trouble with that sometimes to, you know, regardless of what systems you put in place, things such as collusion, which means that more than one person, more than one employee is working together. If you get more than one employee working together to fraud the company, it's much easier to go undetected. You have management overrides. That can happen a lot, and it hides a lot of errors. If anyone can override a computer entry, or they can override something on the cash register if you're running it, that's a little scary. One of the things that we do in the accounting world, a lot of our tax returns, of course, and when my students are doing tax returns and they hit the, and I can see by running a diagnostics that they have overridden a field, that's always a red flag. You should not have to override any item on a tax return, and so I know to go in and look and see what they had done. And of course, internal control, if you've got fatigued employees that they're just so tired they can't function any longer, which is happening more and more and more in today's world as there continue to be cutbacks and each employee is expected to do more and more work. Fatigue, it's just, I mean, you know, you just make mistakes. And negligence, it's, you know, maybe you just get to the point that you just don't care. That happens a lot sometimes, I think, when people aren't paid a living wage, or if you happen to be in a situation where you know that the person working beside you makes a lot more money than you make, and you know that they're not any more productive than you are, but because of the timing of when they were hired or something, they make more money. It's just easy to get to the point of where you're negligent if you're not careful. So again, benefits should always outweigh the cost of any of the internal controls we put into place. One of the main things is in a cash chapter then is how do we know that the information in our cash account is correct. And so we're going to move on toward a bank reconciliation here and talk about how we would complete a bank reconciliation. I would hope that most of you have had checking accounts at least at some point in your life, and I hope that you do some form of bank reconciliation. Again, I learn a lot in the classroom that students don't actually even physically do a bank reconciliation anymore. They will tell me that they get online and look at their transactions often and check and see that those transactions are legit. And as long as you're truly not missing any transaction, and you know that would suffice in a personal account. It does not meet the requirements of Acct. You're not going to ever pass an external audit if you're not doing formal bank reconciliations in your business, the formal bank reconciliations can be completed in your computer software, your accounting software as you go. So you can actually have a computerized reconciliation, but you still must reconcile monthly. So how do we design? The first thing we need to know is understand how the banks work and the bank accounts work. So anytime you go to set up a bank account at the bank, you will have to do a signature card. Those would be the people who are allowed to sign the checking account, the owners of the account. Again, in today's world, everyone has to have a picture ID on file as well with the signature card. It's kind of funny if you ever look at some of the signatures on the checks, if you get many checks, but you know that the bank requires each person to have an authorized signature card, and they say that this protects against forgery. Well, it would protect against forgery if a human eye looked at every check and every signature, but that doesn't happen. I mean, it just really doesn't happen. I've made mistakes lots of times as I'm paying my mom's bills, and I accidentally signed the check, and I shouldn't sign the check. It should have my mother's signature on it, and it goes right through the bank, and they never even catch it and never say anything most of the time. Now, every now and then it'll come back and they'll say, or I'll get a call. Typically, I just get a call from the bank, and they say, oh, but you know, made a mistake. You need to get your mom's signature on this, and it's not a big deal, but it's because we do a lot of business with a small bank, and they know us. It would be a big deal if I was banking in a big bank. They would just suck me with a fee and move on. The deposit ticket, the deposit ticket is used as proof of the deposit transaction. It shows that I took $100 to the bank and deposited it, for example. I keep that in my records, and I check that off against my bank reconciliation. Do I have a deposit ticket for that item? The check has the maker, the payee, and the bank's name on it. The maker is the person who signs the check. The payee is to whom the check is written, and the bank is the bank of which it is drawn on. Here's an example of a check for Mid-Atlantic Manufacturing Company, and they are paying it to the payee of California Office Products. You can see that you have the check number. Notice also that the check number is the last numbers down here after the account number, so the account number on a check. And I think most people know this. I think most people know this, but then I'm always surprised at the people who don't know things sometimes, or things that it seems like you should know, or I would assume people know, and then they just don't. But it's important, or I think it's important for you to know what the actual, I was trying to get a marker here. Okay, finally I get what I'm after. So on the check here, I can look at the routing number. The routing number for this bank would be 121000086. So if I were going to pay with my check online, I would need to know my routing number versus my account number, and my account number would be the 01362131733. And it's also important to realize lots of times now, again, that it's tax season, that when you go to have your taxes filed, sometimes they'll ask you for a voided check, and people tend to rip out a deposit ticket and leave it. And some banks, the deposit ticket has the account number on it, and some banks, they do not. So it's important that you make sure that you have the right routing and account number as the information that you turn in for your tax return, or your refund is not going to hit your account. It's going to go somewhere else. Okay. The bank statement is a report of the customer's cash activity as the bank sees it. Here's an example of a bank statement. As we go forward and we do an actual reconciliation, we'll look at some of these charges on here and what they stand for in a little more detail. And the bank reconciliation tells the difference between the company's cash records and the bank's balance. We end up with an adjusted cash balance, and that adjusted cash balance is the amount of cash that should be on our balance sheet and therefore in our cash ledger account at the end of the month. So for bank reconciliation, there are two records of the business's cash. If you think about this, you have what the bank says you have, the cash account, which would end up on the bank statement, or if you look at your bank account online, it's what the bank account online amount is, and then there is the cash account in the company's ledger. There are differences because of a time lag. I have written a check, but it hasn't cleared the bank yet, for example, or it's a Saturday and business was open and we close at the end of the day and we drop a deposit in the night deposit box, and that is the 31st day of the month, and the bank doesn't open again until the 1st, well, until the 2nd then, and of the next month, and so that deposit is not going to hit a bank statement that ends on December 31st. It would be on our January bank statement, and that would be an outstanding deposit. So there's two sides of a bank reconciliation. This is something that if you're in the classroom, you hear me talk about which side does it go on? That's another thing, I'll say, which side does this go on? Does it go on the bank side or the book side? So we want to think about it this way. When I'm doing a bank reconciliation, I start with the bank balance on the bank statement, and then any item that the bank didn't know about but had occurred, so it's something that's in my cash account but is not on the bank statement, would be an adjustment to the bank side. On the book side, I start with my ending balance in cash as of the 31st before bank reconciliations, and then anything that's on the bank statement that I didn't know about as a business, I didn't know it was going to be there. Maybe I knew it was going to be there, but I haven't recorded. Like maybe I know that I have an automatic rent payment or something come out, or automatic insurance payment, but I haven't taken it out until I get the bank statement. Then that adjustment would go on the book side. And the goal is for our adjusted balance to be equal. If it's not equal, we've made a mistake. So normal items that would go on the bank side would be deposits in transit. And those, as I said, where we dropped it off in the night deposit box. It didn't get put in our account until after the statement cutoff date. An outstanding check, it's a check I've written, put in the mail, mailed off. I've subtracted it out of my checking account, but it hasn't yet hit the bank to be subtracted off the bank's balance of my money. And any error that the bank might make, you will see that errors are corrected on the side of who makes them. If I made a mistake in the company, then that error gets fixed in the company books. If you made a mistake, if the bank made a mistake, then it goes on the bank side. So normal book side reconciliation items include bank collections. Sometimes a bank will collect receivables for you. EFTs, I can either get my paycheck deposited directly, or I might be paying bills directly out. Those are both EFT transfers. I have to see if it's a come in or a go out. A service charge, the fee the banks charge me. Interest revenue, money that I might be earning on my money that I have as a balance in my account. A non-sufficient fund check, a check that was written by someone else and it bounced. You hear bouncing checks. So you're going to be adding back the fee of the check, and lots of times you're going to be adding back a bank fee that they charged you for that bounced check. Not a lot of times, always. And if you order your checks through the bank, they will subtract the cost of printing those checks off of your checking account. And again, there's our little book errors too that we would have. So anything that's automatic out of your checking account, you're going to have to account for that at the end of the month on your reconciliation and do the journal entries to correct that. So here we're going to look at a little example of a bank reconciliation. We have a December 31st bank balance of $5,900, and we have a cash account balance of $3,340. We started and it tells us we had a deposit in transit of $1,600. We had a bank error. The bank deducted $100 for a check written by another company. Okay, so that would be if I'm company ABC and they got in a check written by company DEF and they subtracted the DEF check from ABC's account, and that happens sometimes. They just pulled the amount out of the wrong account. It would get added back to the bank side. Anytime there's a bank error, you're going to want to make sure that you pick up the phone and call the bank as well, because if we don't call the bank, they may not know that there's an error. Outstanding checks we would have, that would go on the bank side. An EFT receipt of your dividend revenue. So that is something that automatically hit our banking account. So we would need to adjust our books for that. A bank collection of your accounts receivable. So again, that's going to show up on the bank statement, and we would want to make sure that we enter that amount into our checkbook and into our cash balance. Interest revenue earned on our bank balance, again, an increase in cash. A book error. This is a transposition. We recorded a check for $510 in our book, and really the amount was only $150, so we need to add back $360 because we subtracted out $360 too much. A bank service charge of $20, so that's a subtraction. Non-sufficient fund check from a customer, we need to subtract that out as well. And an EFT payment for insurance expense, we would need to subtract that out as well. So we read through each of those items, but here's an illustration then of what it would look like. Okay. So you have to make sure that your adjusted balance balances. If it doesn't, again, you're out of balance. And the same rules hold true as do for a trial balance. You need to find your differences, see if it's a common number, divide it by 2 or multiply it by 2 in case you added it to the wrong place or subtracted it from the wrong place, and that will help you find the error. Once we have completed the reconciliation and have our new adjusted balance, we know that according to our bank reconciliation, our balance in cash should be $62.60. But how do we get our account to that? How do we change the amounts in our ledger account? Well, we change it from journal entries and then posting it to those journal entries. So we have to do a journal entry for every transaction that is on the adjustment side for the books. If it's on the adjustments for the bank, it's already in our books and we don't need to do a journal entry. So it's only on the book side that we are doing adjusting entries. So here we had the EFT receipt of dividends, which means we increased our cash and increased our dividends revenue. Next, we had a collection of accounts receivable. We increased our cash, decreased our accounts receivable. We had interest revenue earned on our money in our bank. We got cash, increased our revenue. We had correction of our error, and this was in a check that we had written out to an account payable. So we had reduced an account payable to one of our vendors by too much. So we needed to increase that balance back up for what we really owed them. And we have the $360 cash back in our cash account. And then we have our subtractions, our service charge. So we have an expense of $20, which gets debited, and we have less cash, so we have a credit. We have a non-sufficient fund check that was from a customer, so we need to add that back into accounts receivable. And we have less cash. In our payment of insurance, we have an insurance expense, and we have less cash. After we do that and we post those entries to our ledger, we will come up with our adjusted trial balance. So as a summary, the bank balance always, you add the deposits in transit, subtract the outstanding checks, we add or subtract corrections to the bank errors. For the book balance, we always add any bank collections, interest revenue, and EFT receipts. We subtract service charges, non-sufficient fund checks, and EFT payments. And we add or subtract, depending on what the error is, corrections of book errors. So here's just a little stop and think, and this is right out of your book, but the bank statement balance is $4,500 and it shows a service charge of $15, interest earned of $5, and a non-sufficient fund check for $300. Deposits in transit total $1,200. Outstanding checks are $575. The bookkeeper recorded a $152 check of $120 as $152. A check of $105. I can't even read. A bookkeeper recorded as $152 a check of $125 in payment of an accounts payable. This created a book error of $27, which is a positive amount to correct the error. What is the adjusted bank balance? And what is the adjusted book balance? Or what is the book balance of cash before the reconciliation? How will we go about solving this? Our adjusted book balance is pretty basic here. We had our beginning balance, our bank statement balance. We had our beginning bank balance plus the $1,200 in deposits in transit and less our outstanding checks. The other is a little more involved. Because we needed to determine how much we had as our beginning cash balance, so we have to work backwards with that. We know that our ending has to be $5,125 because that was our adjusted bank balance, and so anything that we would have subtracted, we add back to that. We just do the opposite, plus our $300 minus our $27 to come up with the $54.08. We could check that by starting then to do it the normal way, and that's our beginning balance, and work down the other direction to get to the 125. 51.25. I'm making up numbers. Been a long day. You can access these slides through your My Accounting Lab just the same as I'm pulling them up here. So I'm going to let you walk through this illustration on your own. Just go pull up the My Accounting Lab slides, PowerPoint slides, and they're in the multimedia library, and you can open this and walk through this illustration, or it's also in your book and you can walk through this illustration in your book, and it's just a good way to help cement in and make sure you understand before you jump into the homework. And the last thing that we need to look at in this chapter is evaluating internal controls over cash receipts and cash payments. Again, cash requires specific internal controls because cash is so easy to steal. All transactions ultimately affect cash. Cash receipts should be deposited quickly. Companies can receive cash over the counter or through the mail. If we're getting cash receipts over the counter, it might be point of sale. We may be running a cash register with a scanner, and we're providing control over those cash receipts because we're running a tape, and they're going into the drawer and they need to be counted back, and it should match what the tape says. This records the sale, the cost of the item sold, and the reduction in inventory. The customer should be issued that receipt as a proof of purchase. It's a problem if your customers are not getting receipts because of depending on the store's process, you might be able to use that receipt and put it in the drawer like it was an error and then take that much money. again, you turn in that drawer at the end of the shift and you combine it with all other cash and deposit it all together in one deposit. The accounting deposit reconciles the sales per terminal to cash in the drawer. So you reconcile, someone has to reconcile, but you still, as the person who is going to be held accountable for the cash in the drawer, should be counting that cash back, and you should say, yep, there was $1,000 in that drawer, so that when I read your tape, if I'm in the accounting office and your tape says that you should have $1,010, you know that you have the confidence that you had counted the $1,000 and you are clearly $10 short. When you get receipts of cash by mail, it should not be opened in the accounting deposit or in the accounting office, because they would be the person making the deposits in most cases. So the mailroom perhaps would want to open the cash receipts and have someone record that cash receipt that it came in, preferably 2 people there, and record what amount of cash come in before you send it on to be deposited. So in this company illustration, the treasurer gets the checks and does the deposit ticket and sends it to the bank. The controller then sees how much that was and sends it and gets the receipts from the bank. The accounting department gets the remittance advices. They match it up with the debits to cash from the deposit ticket and send that to the controller as well. So we should work to do payment by check or electronic funds transfer. It helps to improve control, not to have a lot of cash around. You should provide a record of that payment. The check should be signed by authorized officials. EFTs must be approved by authorized officials. And they should be supported by evidence, written evidence, something to show that you have the proper items in place. You should have your invoices, purchase orders, receiving reports all matched up before you pay a vendor. We would want to fax or email purchase orders if we are going to do a payment by check. Receive those goods, prepare that receiving report, receive an invoice, approve all of these documents. You want to make sure that you got what you ordered and the right number of what you ordered. And then you would at that point send checks or authorize electronic fund transfers. Pay your bills online in today's world. So cash payments by check or EFT. If we had a purchase order, we would send that purchase order out to, say, Haynes Textile here in this example. Once that's there, they're going to ship that out, the merchandise inventory, and then they will also mail an invoice. Once we get the merchandising inventory shipped into Mid-Atlantic and the invoice arrives, we're going to double check and make sure that we had all of those items, all of those the 1, 2, and 3, the purchase order, invoice, and receiving report all match before we write the check or send out the EFT. Before I actually want to sign a check or approve, I want to make sure that we have all of these items, which is what I just said. We want to match these items up, and we want to have looked at the actual items in the box, not just say the box receipt was received. You don't always get in the box what you think you're supposed to. Petty cash is just a small fund that we can make minor purchases with. Maybe we get a delivery to the store and we need to pay a COD or on the freight or something, and so we can just go get that money out of the petty cash fund. It should be responsible by one person should hold responsibility to that box. No one more than one person should have access to the key to get into that box. It should be a certain amount of cash. We should do a voucher system for each payment, and that we make sure we have a receipt go in the box for the exact amount of money that comes out. And the sum of the funds paid plus the voucher should equal the set amount of money that we had set. So we had a petty cash fund set for $100 and we had receipts for $45, then there should be $55 left in the box. Cash budgets are a form of control. They help you to coordinate business activities. We plan our receipts and payments. We project how much cash receipts we expect to get and how much cash payments we expect to go out. We start this by beginning with a cash balance. We add budgeted receipts and subtract budgeted payments and equal the cash available before new financing. And we compare our actual cash available to the budgeted cash balance. This helps us decide if we need to have planned borrowing in place. Some months you don't have the revenue come in that, because you're gearing up or you're busier next month. This little cash budget that we have here for Mid-Atlantic Company shows us that they project that they will need to borrow $1,100 to make it through the month. Most companies would have a line of credit in place. You would want to have a line of credit in place so that every time you need to borrow a little tad of money, you didn't have to run out and get it, and get a loan set up. So you just have it set up so that the money comes in and out as you need it. We have just a little simple cash budget here example that you can work through. And then how do we report cash on the balance sheet? We want to know that we put cash and cash equivalents together. You will have a quiz question about this. So cash and cash equivalents include time deposits, certificates of deposits, and high-grade government securities with a life of 3 months or less. Very liquid government securities would be included in your cash and cash equivalent account. You just would call it cash. We would have there's something called a compensating balance agreement. Cash balance should not include cash that is restricted. So you may have a checking account that you are required to keep a balance of $10,000 in, say. And if you're required to keep $10,000 in it, that should not show as part of your cash budget of operating cash budget. And that is basically this chapter. I don't have anyone online to ask questions, it doesn't look like. So this recorded